We talk about financial capital constantly. We talk about human capital with increasing frequency. We build frameworks around both, measure both, protect both. But we rarely talk about attention, even though attention determines the return on everything else. Capital grows where it is allocated deliberately. Attention works through the same underlying mechanism. The difference is that most people allocate their financial capital with at least some intention. Most people allocate their attention almost entirely unconsciously. Every hour, every decision, every perception is shaped by whatever captured focus most recently. If attention is capital, most people are running a deeply inefficient fund. Time is finite and cannot be recovered once spent. Cognitive bandwidth is limited in ways that neuroscience has documented extensively. The mind cannot maintain deep focus and fragmented attention simultaneously. Focus determines the depth of thinking available to you. Depth of thinking determines the quality of insight produced. Quality of insight determines the asymmetric edge that separates sound decisions from average ones. Markets reward asymmetric insight above almost everything else. Genuine insight does not emerge from skimming surfaces quickly. It emerges from sustained, uninterrupted engagement with a problem over time. Uninterrupted engagement requires protected attention as its foundational precondition. This is not a productivity argument, it is an allocation argument. The professional who protects 4 hours of genuine cognitive depth daily is not being precious about their schedule. They are compounding an asset that most of their competitors are quietly spending down. Fragmented attention produces fragmented outcomes, not occasionally, and not only in extreme cases, consistently and structurally across every domain where depth creates advantage. Consider what the modern information environment asks of the investor. Constant market updates arriving at intervals too short to carry meaningful signal. Social commentary, shifting with each price movement and each news cycle. Opinion volatility that bears no relationship to underlying fundamental change. Short-form content designed to capture attention in seconds and release it just as quickly. The assumption embedded in most financial media consumption is straightforward. More information produces better decisions. The evidence does not support this assumption consistently. Every input that enters the mind reshapes perception in some direction. Every reshaped perception influences the next decision, however subtly it operates. The investor who checks prices hourly is not becoming better informed about long-term value. They are conditioning their nervous system to respond to short-term fluctuation as though it carries long-term significance. The more frequently you check the market, the more reactive your psychology becomes. This is not a moral failing or a weakness of character. It is a predictable behavioral consequence of repeated exposure to variable and largely meaningless information. The nervous system learns to treat whatever it encounters regularly as meaningful and worthy of response. Feed it noise consistently, and it begins processing noise as signal. The cost rarely appears in any single decision made on any particular day. It accumulates in the gradual erosion of the calm, patient orientation that long-term investing structurally requires to function. When your attention is constantly rented to platforms and media, your future cannot be fully owned by you. That is not rhetorical flourish. It is a precise description of how cognitive resources actually flow across time. Platforms are businesses whose revenue is directly proportional to the attention they capture and retain. Financial media earns through urgency rather than accuracy or depth. The incentive is to make everything feel important and immediate, regardless of whether it genuinely is. If attention is being systematically harvested and monetized, the person providing it is not the customer. They are the inventory being sold. Here is where the parallel becomes precise enough to carry real weight. Deep, sustained work builds genuine skill over extended time. Skill, developed to a sufficient level, creates leverage within its domain. Leverage creates autonomy, both financial and professional. Autonomy creates the conditions for further compounding to continue. But none of this chain initiates or sustains itself inside a distracted, cognitive environment. Every link in the sequence requires the previous one to have formed with sufficient depth. The first link is always protected, directed attention held consistently over time. The comparison to financial behavior is direct and worth making fully explicit. Scattered, reactive attention resembles active trading in its underlying behavioral structure. High frequency, high friction, high emotional involvement, and returns that rarely justify the accumulated cost. Concentrated, sustained attention resembles long-term investing in its structure and its outcomes. Lower frequency, lower friction, compounding that builds quietly and becomes significant across extended periods. The same behavioral errors that destroy investment returns destroy cognitive returns with equal consistency. Impatience, reactivity, the inability to remain with discomfort long enough for genuine insight to emerge fully. Compounding requires consistency sustained across time without interruption. Consistency requires stability of attention as its non-negotiable prerequisite. The investor who has built genuine capacity for sustained focus is not simply more productive in a conventional sense. They are operating with a form of leverage that their distracted competitors have already quietly spent down. Scattered focus is the cognitive equivalent of panic selling. It liquidates the asset at precisely the moment when holding it would have produced the most meaningful return. Concentrated focus held through difficulty is the cognitive equivalent of patient capital. Uncomfortable to maintain, invisible in the short term, and compounding significantly across the years that follow. It is worth understanding the structural environment with clarity rather than sentiment. Platforms are not neutral infrastructure built for the benefit of their users. They are businesses whose revenue is directly and precisely proportional to the volume of attention they capture and hold across time. Every design decision, every notification system, every algorithmic recommendation optimizes for sustained engagement above all other considerations. The goal is not to inform you or to support your long-term interests. The goal is to keep your attention allocated toward the platform for as long as possible. Financial media earns through urgency rather than accuracy or measured analysis. Calm, long-term perspective does not generate the traffic that breaking developments and dramatic reversals reliably produce. The incentive structure pushes consistently toward making everything feel urgent and significant. Volatility monetizes emotion in financial markets and in media simultaneously and through connected mechanisms. Sharp price movements generate coverage, commentary, and reactive behavior from investors conditioned to treat movement as meaningful signal. The individual investor sitting inside this environment, believing they are making autonomous decisions based on objective information, is operating with considerably less independence than the framing suggests. Attention is the scarce input that every part of the modern information ecosystem is competing to extract. The person who understands this and responds strategically is in a fundamentally different position than the person who does not. Reclaiming attention is not a lifestyle preference, or a wellness practice, or a reaction against technology. It is a strategic decision about where the most consequential, scarce resource gets allocated. Fewer total inputs, selected with genuine intention rather than passive consumption. Longer thinking cycles that allow problems to develop beyond their initial surface presentation. Delayed reactions that create meaningful space between information received and response generated. A structured information diet that treats cognitive exposure with the same seriousness applied to financial exposure. Raising your attention floor does not require dramatic restructuring of daily life. It requires the recognition that attention is finite, that its allocation compounds across time, and that protecting it deserves the same deliberateness as protecting capital. Wealth is not built only with money. It is built with sustained, directed thought, applied consistently across time. The decisions that produce long-term financial outcomes are downstream of the cognitive environment in which they are made. Protect that environment and the quality of decisions improves structurally. Erode it through constant distraction and reactive consumption, and even sound financial principles become difficult to execute with any consistency. The world competing for your attention is not doing so passively or accidentally. It is a structured, well-resourced, continuously optimized competition for the one resource that determines what you build and what you become over time. Most people have never fully accounted for what they spend their attention on. They track their financial portfolio with more rigor than they track their cognitive one. And yet the cognitive one is upstream of every financial decision ever made. The quality of a life, examined honestly, reflects the quality of attention sustained across it. Where focus goes consistently, depth follows. Where depth forms, edge emerges. Where edge compounds quietly over decades, outcomes diverge from the average in ways that become very difficult to reverse. In an environment where attention is the scarce input, the person who controls theirs controls their outcomes. That is not inspiration. It is simply how allocation works across every asset class that compounds. In a world competing relentlessly for your focus, the ability to hold it deliberately may be the rarest form of capital you will ever possess. Not because sustained attention feels virtuous or disciplined, because in the economy that actually governs long-term outcomes, it is the input that everything else depends on.